Charles, welcome back. It's been a couple months since you've been on Investor Insights, but always happy to have you here, offering your insight on markets, CRE, and everything else that's going on in the world of finance. Welcome.
Absolutely. Glad to be here again with you and as well as our investors.
Yeah, it's been an active time for EM Investment Partners, and for investors that might not know, EM Investment Partners is the investments arm. They're sourcing a lot of the investment opportunities on the platform, vetting them, going through IC, the investment committee, and CDA or Charles here is one of our really smart gurus when it comes to putting together the market data, and you might have seen on some of the offering pages and in some of our communications to investors, this market framework that we've been working on. Charles,
Right.
can you tell me a bit about that markets framework?
Yeah, absolutely. And pleasure to get into more detail on that. Excuse me. And can't solely take the credit. Obviously, it's truly been a team effort within the real estate team at EMIP, mostly together with my colleagues Milan Parek and Henry Kwong. We essentially sought to develop this proprietary framework, kind of modeled after what some of the larger institutional investors or PE or E players essentially do in the space, to really get to an unbiased tool to continuously assess domestic investment markets. And so what we mean by that is obviously market data and markets and sort of the rationale behind those are constantly shifting on a sector by sector basis. And as we seek to sort of leverage the insights we have as EMIP, but also bundle that with that sort of live and latest set of data that becomes available, we essentially, through sort of these various internal discussions and calibrations, came to this model that essentially centers around 11 factors, which we can obviously get into more detail to for our investors. But again, with the objective to qualitatively and quantitatively assess each market and rank them accordingly.
Yeah, and I guess maybe it circles around. Some investors might wonder how we pick the market, how we pick the asset class. It's not
Right.
just a finger in the wind trying to get a sense. There's a lot of data that goes into it, and I know Green Street is one of the big proprietary data providers, but we also have an internal methodology. Maybe you can get into how we rank these markets. So investors can see we've got a fancy slide there.
Right.
What's the machinery that brings us to our final output of that EMIP score?
Yeah, our investor will be able to follow along with the slide. There's a lot of content here to digest, and happy to obviously follow on questions that our investors may have after the webinar, or even one-off separately. But essentially, the starting point for us was, again, that institutional framework. As EMIP, we obviously are connected, to your point, to a variety of third-party resources, as is the case for many others in the PRE space. We can also leverage our strategic partnerships, for instance, right? So we're partnered with Marcus and Millichap, as most of our investors would have seen, who are a leading middle market broker, and are so-called boots on the ground for us to provide local market intel. And then we have our proprietary network of well over 400 different middle market sponsors, brokers, lender relations, et cetera, that we as a firm have built essentially over the years. So these insights culminate into one cohesive or stable model, which is up on the slide, that accounts for quarterly updates in data, as well as shifts in these underlying markets to guide our discussions when we review these opportunities at our investment committee, et cetera, right? And so even looking ahead as well, we let this model and sort of the data guide us, obviously, in terms of discussions on where to concentrate our origination and business development efforts on a go-forward basis. And so it's really sort of an all-encompassing tool for us, which is kind of the mindset which we developed it. As most investors will note, a large part of this information or data is ultimately sourced from Green Street, as you mentioned. But Green Street truly sort of present their data in an unbiased, kind of non-driven by the underlying market or sector or deal sentiment sort of manner. And we feel that is a good starting point, as it is for a lot of other institutional PRE investors. And so our model essentially breaks out into two different tiers. We have tier one, which are sort of the market quality and sort of the demographic components that go into our model. And then we have tier two, which are the investment opportunities. I can do a brief run through these factors to give everyone sort of a sense of what goes into it and why. So if we start at the tier two sort of category, that breaks down into MREF, PAF growth, risk-adjusted IRR, and deal volume. So MREFPAF growth, for those not familiar, is market revenue per available foot. It's essentially an all-encompassing metric that is probably the sort of gold standard indicating real estate metric for evaluating markets. And the reason I say that is because it factors in both supply as well as demand, because it comprises essentially occupancy growth times the rent growth, right? And so it's a dual metric that tracks obviously opportunity for upside through rent growth or mark-to-market potential, but also how that is viewed in the context of new supply coming online and where demand is in terms of where the occupancy stands. So obviously, from a market perspective, you'd want to pursue markets that show a growth in occupancy, but also show a growth in rent, right? So that there's further opportunity for upside. And so markets that show both and show both in a strong manner will have a higher MREFPAF growth over the next few years relative to some of the other markets that are maybe oversupplied or where rent growth has kind of run its course and the upside potential is limited over the next few years. And so higher MREFPAF growth markets are generally more favorable. And so that's absolutely one of the cornerstone metrics in our model for those reasons as well. Then looking sort of broader and putting this into sort of a more rational thought context, MREFPAF growth and occupancy and rent growth trending in the right direction is all wonderful. But it doesn't necessarily mean much if the market and the competition for assets is such that you're buying at a basis that is highly competed amongst different bidders or different buyers for properties, and where that then in turn limits your IRR potential, right? Obviously, the going in basis relative to your exit basis is the main driver of value and investment returns. And so aside from having favorable occupancy and rent growth, you'd also want to see a risk-adjusted IRR profile that is favorable as well. And so we again utilize that metric based on various markets as well to basically rank the markets accordingly as in terms of sort of most upside potential or entry-level potential for our investments. And then as a third sort of block to this tier 2 set of factors, all of that is all nice and well, but if there is no capital going in or out of the market in terms of liquidity not being necessarily available, that can in turn harm your investment potential as well, where being able to buy into an opportunity but not necessarily being able to exit out of that opportunity because there are no buyers or takers at that point can be harmful. And so we look at deal volume specifically trimmed down to the middle market size, so sub $100 million, to essentially gauge or use that as a proxy for where liquidity is in these individual markets, and obviously pursue the more liquid ones versus the less liquid ones. So that's really a core component. Obviously, the individual weightings and how this gets processed in our broader model is all proprietary, but hopefully that piece of it gives investors an understanding of the core components. And then the pivot into tier 1, I would say tier 1 is essentially a combination of more qualitative factors as well as certain factors that we at times, for strategic purposes or given where the macro conditions are for markets, would like to over or underweight for certain markets. And so what I mean by that is obviously we'll look at qualitative market quality as a whole. And so that's denoted or captured by the Green Street market grade. So Green Street have their proprietary view on markets throughout the US, which they capture in essentially a letter grade ranging from A++ to D, with A++ being most favorable. And those market grades are in and of themselves based on 10 underlying variables, which include 3 variables that are specific to the real estate sector one may look at, right? So, for instance, for industrial, that would be tonnages shipped or processed or proximity to port and things of that nature. And so it is catered to sort of an individual sector. And so what that market grade ultimately tells us is how desirable and how appealing is the market given where current macro data is and given the positioning of the market, which is obviously key as well, aside from just purely the quantitative data. There's other qualitative factors that go into tier 1 as well, including regulatory friendliness, which can be a main sort of hurdle for supply and ongoing demand, but also for ability to execute business plans to a certain extent, to the extent that there may be redevelopment or turning around a certain property. And then there are a handful of factors that we'd like to strategically over or underweight depending on the macro sentiment. So those include, kind of not surprisingly, your more generic factors such as both sort of pure demographic growth, but also office using job growth, for instance, for office and office ancillary sectors or products that we look to invest in, as well as very sector-specific job growth, right? So job growth in the finance or real estate or tech and advertising and media industries, right? And so we may at times over or underweight that depending on our house view on where macroeconomic conditions for specific markets are or where we see opportunities. And then as a final sort of component in tier one, I would be remiss not to highlight our kind of fully proprietary and in-house EMIP sports and culture score, which actually predominantly driven or led by our chief investment officer, Marius Schulzen, where that sort of metric is based on the premise that, or the belief that we have at EMIP, that presence in markets that offer sort of a multitude of either sports or cultural offerings. From a, for instance, residential perspective, given multifamily is a cornerstone investment sector for us, tend to be more prevalent or more appealing to sort of residential in-migration and sort of factors for people to essentially live and work and play in, right? And so a market such as New York, or LA, which kind of offer kind of all of the above, sports in abundance, obviously cultural offerings left and right, really well-established restaurant and food and entertainment scenes, obviously sort of rank at the top of that. But obviously, to not dismiss sort of other markets in the US, we have come up with a proprietary system that essentially gives credit to both those markets that I just mentioned, but doesn't fully dismiss markets such as, for instance, in Austin, right, which has an exceptionally strong college scene, college sports scene, obviously appeal of life and work-life quality, live music, entertainment, et cetera. So that's a strong regional entertainment hub in and of itself. And so within our system, we sort of try and allocate a certain score, or call it, for lack of a better word, sort of quality of life or livability of these cities, and therefore appeal. And so to conclude, once we sort of bundle these 11 factors in our proprietary model, we assign sort of different weightings on a factor-by-factor basis. We then essentially arrive at a score that ranges generally from 1 to 10, with 10 being the most desirable, and that then allows us to rank and publish the sort of top 50 markets and track those a long time as well.
Yeah, it's a pretty comprehensive list of factors, and a lot of thought, I think, has gone into this. I think you told me that it takes about an hour for all the data to compile when you're putting it together in your model. This is all great, and I also want to emphasize for investors that it's not just one market and one asset class. This is market and asset class pairs, and we'll get to that later on, right? And it's the top 50 markets with the major asset classes.
Absolutely, that's a good point. And just to jump in there, important to note that this is very much a human-driven process. I know we're in the midst of AI innovations and supplements left and right. This is very much still a old school sort of ground up process where we're pulling in the data, we're doing human review of this data, and on a quarterly basis, there's calibration meetings between myself and my colleagues, Millen and Henry, to essentially vet what the data is telling us and contrast that, most importantly, to what we're picking up in the market, right? So we're obviously in daily conversations with various sponsors, both on the sort of investment opportunity side, where we see a plethora of investment opportunities come in that we screen, but also on the asset management side with Henry's team, where we, on an ongoing basis, evaluate the investments that we actually currently hold, right? And so infusing that sort of qualitative data and those takes of talking to sponsors and our kind of quote unquote boots in the ground, or even incorporating pieces of Marcus and Millichap and our strategic partnership there, really guide us from a human element in terms of determining which markets make sense, or what is the data showing us? Does that make sense, or does that not make sense? Are we seeing that in the market as well? And then ultimately arrive at sort of our market rankings. I would be remiss if I didn't mention that we've chosen to publish the top 50 markets. I have to cut it off at some point. But that's not to denote that the number 40 or 50th ranked market is a market that we would not necessarily invest in or be attracted to, right? It should be viewed in a relative context, where obviously a 40th ranked market is less appealing than a top 10 ranked market. But there is a nuance here, which I think just on the surface, looking at just purely data and rankings is maybe missed, which is important to note, is this data and the viewpoint and the rankings are all centered around an institutional sort of market level view of where investments are. And so this is probably, in that sense, more institutionally geared. And what I mean by that is the Blackstones of this world or other large investors that are deploying hundreds of millions of dollars, they're investing in a sense of market beta almost, right? Where you're deploying capital at such a magnitude where the market is going to dictate where the returns for that capital and where the opportunities are going to end up. We as Equity Multiple have another advantage relative to that, where we're not necessarily investing in market beta. We have our sponsors and our unique sponsor relationships where, because of their sort of local intel and local relationships, a lot of times we're able to source opportunities where our sponsor is able to acquire an asset at a 20 or 30% discount to where comps or where the basis should be, right? Or find that one asset that is managed by sort of an individual that's not necessarily a real estate expert and not to say mismanaged, but probably more so a lack of adequate or efficient management. And then our sponsors that are more institutional grade are able to come in, professionalize the management and capture upside maybe through mark-to-marketing rents for 10, 20, 30% as we've seen on deals in the past, right? And so those unique factors really unlock alpha at the middle market level. It's kind of capitalizing on the opaqueness that is just affiliated with middle market transactions in general. And so that's an important distinguishing factor here where our sponsors, because of that, are able to find the opportunities that actually make sense. So you could very well have a situation where macro-wide, beta-wide, we're ranking the market as the 48th or 50th market. But from a sponsor alpha perspective, this is the opportunity that the sponsor was able to source at a basis that's 20% lower and a mark-to-market that makes sense and is able to generate just purely on that opportunity alone opportunistic level returns for very much light value add or maybe even borderline core plus risk. And so that dislocation is something that is a unique factor to us and should be viewed in context of these markets as well. Obviously, that said, we prefer to be in markets that show strong fundamentals and trend well from a beta perspective. But even the markets that are not necessarily the top 10 could still be very, very compelling depending on the unique sponsor stories there. So I think that is absolutely a key factor to take into account for this as well.
Yeah, it's somewhat forward-looking. It's somewhat where the market is and what the prices are looking like and what the set of circumstances are for a given market. Are we seeing this being used in our investment committee, our sourcing, our investments? How are we getting value out of this model that you all have created?
Yeah, absolutely. So again, as I mentioned, we update this on a quarterly basis per the latest data that comes out from the various sources that we utilize this in. We tend to shy away from recalibrating the model. We don't want to necessarily bias this on a quarterly basis. So we have a calibration in place that only in extreme measures we kind of nudge into potentially new rankings, but essentially we let the data guide us towards new rankings. And then once those rankings are set, as I mentioned, we have a sort of guiding hand, right? Obviously, the top 10 or 15 or 20 markets or wherever you want to place that cutoff are markets that are highly compelling for, again, those beta fundamental drivers. And that's the viewpoint or the lens that we apply in investment committee as well. So in investment committee, we obviously weigh many different factors: sponsor background, the underwriting, the pro forma, the underwriting sort of forecasts, the investment opportunity themselves, the market, which is where this sort of model obviously also factors into. And so I would really say it's a sum of the parts discussion rather than what is the market? Oh, it's number 25, it's a go, or it's number 26, it's a no-go. It's not black and white like that. It's much more of a broader discussion. That said, this model does guide us in terms of it being a really favorable market, and that then maybe pushes an investment to the forefront as maybe for investors' benefit. They might not necessarily fully be aware of this, but at times we have decisions to make at RIC where it's kind of the best of two opportunities. And we're looking at it from the investor set as to which opportunity would be most lucrative to our investors. And so in those discussions where, for lack of a better word, there's two opportunities that are truly neck and neck with one another, maybe the market ranking could be a skewing factor in that and say, hey, this is a much more favorable market, a much more fundamentally sound market. So that then, in our opinion, de-risks the investment. And so if you view that in context of where the returns are projected to, what the quality of the sponsor is, what the asset sector is, what the sort of local market story is, it may very well make sense to pursue opportunity A versus opportunity B, right? And so I would say it's a guiding tool, and then for existing investment decisions. And then on the business development side, I would say it's a tool to kind of guide those efforts. So if we know that a set of markets are consistently hovering in the top 10 or 15 or 20 markets, and we are looking at new markets to drive new business and source new opportunities from, in-house, it obviously makes sense to kind of focus our efforts on the markets that are trending in a favorable direction versus markets that we see are weakening or softening and maybe not as favorable. And we obviously have limited resources to deploy. And so where we deploy those resources obviously has to tie or correlate somewhat to what our outlook is of these markets, as opposed to kind of burning those efforts on markets that not necessarily going in a favorable direction.
Now, putting this into practice, and Ashley Shoemaker will get into some of the specific industrial investments that we've got on the platform in the next couple of minutes. But, maybe you can give us a bit more background in terms of where industrial is currently ranked, or what the rankings look like for the EMIP market framework for industrial.
Absolutely. So we can definitely get into more into the industrial sector and highlight that. And I also like to, I guess, use that as a case study, contrast it versus the investment framework and the factors that we just discussed. And so obviously industrial is a key sector we look at. It's a sector that's shown strong fundamentals and continues to show a strong outlook. And so as such, I think it's a good example to go over. And I brought along a couple of slides today where in particular this summary by Green Street, that's coming up on the next slide, does a great job of highlighting the various sort of macro and micro and fundamental drivers for the sector, right? And so that's obviously, when we look at our sector view for industrial, that's obviously something we take into account, that part of our 11 factors overlap with as well, and that we then basically digest into these rankings. So as visible on the slide here, industrial is obviously driven by sort of obvious factors such as GDP, trade growth, production, but also more recently driven by e-commerce, retail sales, and change in inventories, with sort of, as we've spoken about in recent webinars, the propensity towards e-commerce and how that really has matured throughout COVID, with a lot more online ordering going on, people becoming a lot more confident and comfortable with having goods delivered to their doorstep, and sort of the last mile portion of the industrial space really picking up in terms of growth to cater to that. We've seen obviously a strong fundamental driver there. And then these drivers combined then pair or contrast against the availability of space. So that's new, existing, as well as obsolete inventory, which is going offline, which, again, to bridge that to our investment framework model, is why the MREV or that market revenue per available foot metric, why that is such a powerful metric, right? It captures both that supply as well as the demand, but also the rent growth by market. And so really this middle segment of this chart here is encapsulated in that metric. And then we obviously have the other factors that account for the other drivers to then arrive at what does sort of demand and supply look like for the coming years, and try to obviously project that on a market by market basis. So if we go to the next slide, in terms of the current state, the industrial sector, again, has been very compelling throughout the pandemic. In the past 2-3 years have essentially marked the best period in history for industrial fundamentals. Just a couple of stats, but national MREV grew over 40% cumulatively, pretty much in excess of the past 7 years combined. And obviously this has slowed down somewhat, but it's still hovering around the 5% mark. And you really had a sort of set of tailwind elements driving that, right? So you had pent-up demand driven by the pandemic sort of consumption boom. You had a deceleration of new supply deliveries, and so some constrained supply in some markets paired with sort of that higher last mile demand really sort of propelled these sector fundamentals. And to quote a couple other different stats that we've recently covered in other webinars as well, as of the first half of 23, we had nominal growth in e-commerce outpacing brick and mortar at almost 7.5 to 2.7%. And then e-commerce generally requires about 3 times the amount of the footprint of brick and mortar, right? So that's another underlying fundamental driver as well. So as businesses continue to essentially outsource to third-party logistics, particularly on this last mile block, we still see an increasing lack of available industrial space, particularly in or near highly populated areas, as well as some workforce challenges. And then there's some macro factors as well that go into our broader market view. So in the near term, we've had severe drought at the Panama Canal and some geopolitical instability at the Suez Canal, kind of adversely impacting the eastern or Gulf Coast ports and driving some of the traffic back to the West Coast. And then longer term, there's sort of other drivers such as nearshoring happening with production and trade moving to Mexico instead of China, which used to be the major trade partner for the U.S. And then we've had onshoring as well, particularly with the electric vehicles and semiconductor space due to the CHIPS Act. That as that production has shifted sort of domestically, that's been driving a lot of the domestic demand. And so those two factors are kind of underlying and more at the institutional level. At the middle market level, we continue to see the impact there as well. And I guess the key takeaway there is that because of all these fundamentally positive drivers, we've seen industrial vacancy down to a record low of like 4.5% this year, near the recent record low of around 3% about a year ago. And the tightening markets have then in turn pushed asking rents to over the last year 26% year-on-year increase, and then normalizing projections indicate a growth of about 4% per year through the next 3 to 4 years. And so that's really where we're driving our kind of fundamental factors in for our model. So in summary, if I go to the next slide, with our market rankings, we can show that we are bullish on kind of the default larger markets. Not surprisingly, logically include markets such as the nation's premier port and hub markets. So LA, New York, Dallas, Fort Worth, Atlanta are all sort of near the top here. But we also have markets that have thrived in a post-COVID economy, such as Miami and Florida. I've obviously seen a tremendous in-migration, and then that paired with that last mile dynamic, as well as cities such as Orlando or Tampa, being able to essentially reach a vast majority of the southeastern U.S. population within 1 to 2 days of trucking delivery times has been a massive catalyst as well, right, for those types of markets. And Miami and those Florida markets essentially always served as a gateway market of sorts to Latin America. And so if you pair that all together, that essentially underpins the rationale there. And then northeastern markets such as New York and New Jersey, just proximity of ports and population in Northeast being one of the most populous. I think it's the top 10 GDP in the world. If you just isolate our segment here in the Northeast, that is essentially a major driver, which continues to propel industrial demand. And again, against the backdrop of the e-commerce evolution we've seen and the last mile growth. So this is kind of our house view here, and hopefully that's a helpful guide to our investors.
Yeah, I had a conversation with one of the sponsors on a currently available offering. I think it's the Portal Co-Warehousing, just talking about how the supply chains have shifted, and not even just reorganizing and being more efficient, but getting a lot more smaller in terms of supply chain. Not just big distribution centers, but small bays, a lot more bespoke supply chains, you might call them.
Right.
CJ, this is an excellent amount of work. Hopefully we can share a lot more of this in the coming quarters as we adjust this, but appreciate you going into this deep dive, and thanks for joining us today.
No, excellent. And spot on in terms of the multi-bay. We didn't necessarily cover that in much detail, but obviously as the larger demand for the larger spaces picks up, it's become incredibly or increasingly harder for our smaller bay tenants to find space, and sort of these sole proprietor businesses to fit into that model of even these small proprietors. They have to also ship at a certain time frame, right, to meet customer expectations on the other end for online businesses. And so as they require space, that then drives demand in the multi-bay space, which is obviously some of the opportunities we'll cover as well. And so it's really across the board for industrial that you're seeing this impact and this tremendous growth opportunity. So a lot of excitement, and hopefully our investors will get to participate in that excitement and that upside.
Great. Thanks for joining us today, and we'll talk again soon.
Likewise. Thank you.